Old-fashioned corporate finance basically says that the goal of the corporation is to produce steadily rising earnings per share. So that's the vanity metric, earnings per share. And there are lots of ways to produce earnings per share that end up hurting your shareholders. That was the basis of the whole Stern Stewart and Company consulting firm. Earnings per share don't count and dividends don't matter were our mantras. And so companies could produce, the conglomerate form lends itself to earnings manipulation. That's why Jack Welch produced his incredibly successful conglomerate. The role of all the financial companies was to allow him to meet each earnings target as it came. He never missed an earnings target in 20 years.
So it can work?
Well, it can, but no one else was able to make it work after he took it over. And I like to think that he ended up acquiring stupid investors. They were earnings groupies that as long as he met every earnings target, they would follow him and raise his stock price. But when this is the funniest story, Jeff Immelt, when he took over the reins from Jack Welch, he said he went around and he met the institutional investors. He said they had no idea what the company did. He said, this is on you guys. You're stupid. And he was amazed by how, complacent and uninformed. So earnings per share will attract not very sophisticated investors. You will get people that,
G's the exception that proves the rule. This whole period during the 80s and 90s and beyond, to me, it looks like the search for the correct yardstick, the correct metric upon which to judge the success of businesses and incentivize people.
And that was the foundation of the company that I was a co-founder of.
And so it started with earnings per share.
Yeah, performance measurement.
Okay, and then what did it go on to? What was
it went on to return on capital, operating return on capital. And then we invented this measure called economic value added, or EVA, which is basically, it's the amount of investment multiplied by the difference between the rate of return on capital and the cost of capital. That's how much value you're creating. Again, it's the volume of capital investment multiplied by the spread, the investment spread. That's value creation. And then we model the value of the firm as a multiple of that EVA, and then we call that market value added, or MVA. And it's basically the difference between a company's market capitalization and its book value.
And the reason you can't just use a simple profit metric is that it doesn't take account of the free cash flow problem. Is that
No,
correct?
it doesn't take account of the cost of capital.
Yeah.
There's no cost measure. Yeah. It accounts for the interest payment, but it assumes equity capital is free. So that at bottom is the problem with the Japanese economy, the German economy. They all view capital, and the Chinese economy in spades. The capital is free. There's no cost associated with it.
So the EVA, it looks like a really sensible model to me. Why isn't everyone using it?
Well, because it was very popular for a decade. It was on the front cover of Fortune magazine in '93. We had maybe 160 clients and at our peak. And then the dot-com era came along, in which operating cash flow no longer seemed to matter. What seemed to matter was growth. And all these superstar companies emerged. And so, the value companies started to trade at really low multiples, like 5 or 6 times. That's when Warren Buffett lost his touch, and he underperformed the market because the market was focused on these growth opportunities with revenue as the sole measure, and EVA just went out of vogue. So it only became appropriate for companies that were generating steady cash flow. If you were a company with growth aspirations, you would lose your managers, because it just wouldn't, your value creation wouldn't show up in the EVA measure because it's not in the cash flow. You were no longer if you have to be cash flow positive, unless you have a way of, or you can capitalize your expenses that you think, R&D, we capitalized R&D, for example, but you'd have to capitalize brand building, employee training. There are ways of doing this. And I have an old former partner at Fortuna Advisor who's doing just that. He's creating a better measure of EVA for growth companies, but it's one that recognizes lots of expenses as capital investment.
Do you think the answer is a formula?
I don't think it works. The fact that companies, no one has seen fit to try to design this with that ingenuity, I think, Amazon is my prototypical company, and they create the more value they lost every year in terms of earnings, the higher their market value became. The higher their losses, their market value would increase by multiples of that, and the reason was that they were investing in their future like mad. And for a while, unsophisticated investors would look at this and say, this is not working. This is a disaster. In fact, we were once hired.
Even sophisticated investors.
Yes. Oh, lots of sophisticated investors thought Amazon was failing around 2002. We were hired at Stern Stewart by somebody to determine if Amazon was going out of business. And we had to reassure them that no, that this company is investing heavily, and the returns on this investment they're now making, they don't show up in accounting statements, but they are going to be very good.
But is there a meta lesson that can be taken from that? It's like, because even if sophisticated investors could get it so wrong, what weren't they seeing? Or what was their mindset? Why was their mindset wrong?
Because they hadn't been forced to dig into the numbers to look at the prospective margins on each dollar of investment. They didn't really understand the business model.
So you just got to understand the actual business model. You can't just do it on a balance sheet.
You have to be a really good investor. You have to devote your life to this stuff if you want to understand a company. And Amazon basically broke the mold. They basically went in their 1997 shareholder letter. They said, "Look, folks, we're different. We're not managing for GAAP earnings, and if GAAP earnings goes in the opposite direction, we're investing in our future. We want you to know that." And we will share with you our investment process, but we want like-minded investors. If you don't get, sell our shares. We don't want you. You're not our kind. And Progressive Insurance was like that. They actually, you were not allowed to talk about earnings at one of their meetings. They had this cult of they didn't have EVA, but they did monthly broadcasts of their P&L. So we say, we just want you to see our raw numbers. We're not hiding anything. This is how much we took in last week. This is how much we think our expected losses were. And this actually came when they passed Reg FD. So they were worried about how much of this do we have to share with our investors. They ended up finding that the volatility of the stock dropped after they started releasing monthly operating forecasts. They thought the volatility was going to increase because if you provide more information, the whole story is, quarterly earnings is terrible. That's why the U.S. investors are so short-sighted, because they broadcast too often. Well, no, the answer is if you broadcast and commit to broadcasting every month your operating P&L, you got investors who are going to support your stock. They're going to understand you. They're going to be confident in your disclosures. You're not converting them into accounting earnings where all the fancy manipulation takes place. They get to see for themselves. My theory about earnings is all investors really want, they want to know your revenue and they want to know your costs and a breakdown. They will build, every good investor builds his or her own earnings statement. They say this is normalized recurring earning. So, and how much confidence do we have in that? That will tell us what multiple to put on it.
It's a really good observation, because you're absolutely right. People go on and on about quarterly earnings and a fixation on it, but if you extrapolate it out and you say, okay, well, companies are only going to report every 2 years. Think what the volatility in the stock would be, because everyone's uncertain. They don't know what the impact on the company is, and so there's wild speculation. Transparency for sure is going to introduce.
My favorite statement by Michael Jensen is, managers may be myopic, that is short-sighted. Markets are not. But the thing is, every manager I know, or so many managers I know, think markets are short-sighted. They all think that they're going to get punished for earnings. And I remember going to Philadelphia in a roundtable there were a bunch of CEOs, and I said, you can change your investor base by how you talk to them. If you talk about earnings all the time, you're going to get dumb investors who will keep you on a short leash. If you say, we're not going to offer earnings guidance, you will get more sophisticated, far-sighted investors. They will be attracted by the very fact that you are abjuring earnings as your, predominant measure.
It's the opposite of the cult of EPS.
Yeah, exactly.
You can manifest your own.
But you attract. It's about a dialogue with investors. Investors should be your partner. Like Warren, we all want Warren Buffett sitting on our board. And the way you attract Warren Buffett, who never talks about earnings, is by not talking about earnings yourself.